Okay, so you keep hearing people talk about the stock market, and some of it sounds like a foreign language. Bulls and bears, tickers, dividends, index funds, all of it thrown around like everyone already understands it. Here's the truth. Almost nobody was born understanding this. Every single investor alive today once sat exactly where you're sitting right now, confused by the vocabulary and unsure where to even begin. So let's actually start from zero and build this up piece by piece, the way it should have been explained the first time. At the most basic level, a stock is a small piece of ownership in a real company. That's it. That's the whole idea underneath every headline you've ever seen about the market. When a company wants to raise money to grow, it can sell tiny slices of itself to the public. Each slice is called a share. If you buy one share of a company, you now technically own a tiny fraction of that company, its buildings, its products, its future profits, all of it, scaled down to a size small enough for an ordinary person to actually afford. Here's the part that surprises a lot of beginners. You don't buy stock directly from the company itself, and you don't walk into a physical building to do it. You buy shares through something called a brokerage, an app or platform that connects your money to the wider stock market. Decades ago, buying a single share meant calling a broker on the phone and paying a real fee for the privilege. Today, you can open an account on your phone and buy a share, or even a small fraction of a share, in a matter of seconds, often without paying any commission at all. So once you own a share, what actually happens next? This is where a second concept comes in, something called a stock exchange. Think of it like an enormous, constantly running marketplace where millions of people are buying and selling tiny slices of thousands of different companies at the exact same time. The two biggest exchanges in the United States are the New York Stock Exchange and the NASDAQ, and together they handle an almost unimaginable amount of buying and selling activity every single trading day. Here's the part almost nobody expects when they first hear it. The price of a share isn't set by the company. It isn't set by any single person deciding what it should cost. It's set entirely by supply and demand, moment to moment, based on what buyers are willing to pay and what sellers are willing to accept. If more people want to buy a stock than sell it, the price rises. If more people want to sell than buy, the price falls. That single mechanic explains almost every confusing price swing you'll ever see. Now, this naturally raises a question. Why would the price of a share change at all if the company itself hasn't changed? A factory doesn't disappear overnight. Employees don't vanish in an afternoon. But here's the twist. A stock price isn't really measuring what a company owns today. It's measuring what investors collectively believe that company will be worth in the future. Good news about future growth pulls the price up. Bad news, or even just disappointing news compared to what people expected, can pull the price down, sometimes within minutes. This is exactly why a company can report a profit and still watch its stock fall. If investors expected an even bigger profit, the actual result feels disappointing by comparison, even though the company made money. Expectation, not just performance, drives an enormous amount of what happens to a stock price on any given day. So far, we've been talking about buying individual company stocks, one slice of one business at a time. But here's something most beginners don't realize exists, and it happens to be one of the most common ways ordinary people actually get started investing. Instead of picking one company, you can buy a single investment that holds tiny slices of hundreds or even thousands of companies all at once. This is called an index fund, or an exchange-traded fund, often shortened to ETF. Picture it like buying a single basket that already contains a small piece of an entire orchard, rather than betting everything on one tree. If one company in that basket struggles, it's a small piece of a much bigger picture. If one company thrives, it contributes to the basket without you having had to pick that exact winner in advance. This single idea, spreading your money across many different investments instead of concentrating it all in one place, has a name. Diversification. And it's one of the most repeated pieces of guidance in the entire world of investing, precisely because putting all your money into a single company carries a level of risk that a diversified basket simply doesn't. Here's where we need to talk honestly about the uncomfortable part of all this, because a beginner's guide that skips it isn't actually being helpful. The stock market carries real risk. Prices can fall, sometimes sharply, sometimes for reasons that have nothing to do with anything you personally did. In 2008, a crisis in the banking system dragged the entire stock market down by roughly half its value over about a year and a half. In early 2020, a global pandemic caused a similarly dramatic crash in a matter of weeks. Neither event asked permission first. Neither one cared how carefully any individual investor had done their research. But here's the other half of that same story, the part that gets left out of a lot of scary headlines. After both of those crashes, the broader market eventually recovered and went on to reach new highs. That doesn't mean every single company survives every crash, because plenty don't. And it doesn't mean recovery happens on any guaranteed timeline, because sometimes it takes years. What it does mean is that historically, investors who panicked and sold everything during the worst of a crash often locked in their losses permanently, while those who stayed invested through the storm gave their investments time to recover along with the broader market. This brings us to one of the most misunderstood words in all of investing: volatility. It simply means how much a price moves up and down over a given period of time. A stock that barely moves day to day has low volatility. A stock that swings wildly, sometimes by double-digit percentages in a single week, has high volatility. Here's the twist beginners often miss. Volatility isn't automatically bad, and it isn't automatically good either. It's simply a measurement of uncertainty, and different investors have very different comfort levels with how much uncertainty they're willing to sit through. So how does someone actually decide what to buy, if they decide to buy anything at all? This is where a concept called time horizon becomes essential. If you might need your money back in a year or two, putting it into individual stocks or even a diversified fund carries real risk, because there's no guarantee the market will be up exactly when you need to withdraw. But if you're investing money you won't touch for many years, even decades, you have far more room to ride out the inevitable dips along the way, because history has given long-term investors far more time to recover from short-term storms than short-term investors ever get. There's also a concept worth understanding before you ever place a single trade, and it's one of the simplest ideas in this entire video, even though it sounds technical. When you place an order to buy or sell a stock, you can choose a market order, which executes immediately at whatever the current price happens to be, or a limit order, which only executes if the price reaches a specific number you set in advance. A market order prioritizes speed. A limit order prioritizes price control. Neither one is universally better. They're simply different tools for different situations. Here's something else worth understanding clearly, because it quietly separates realistic expectations from unrealistic ones. Some companies share a portion of their profits directly with shareholders through something called a dividend, a regular cash payment simply for holding the stock. Other companies pay no dividend at all, choosing instead to reinvest every dollar of profit back into growing the business further. Neither approach is automatically superior. They represent two completely different philosophies about what to do with a company's profits, and as an owner of a tiny slice of that company, you inherit whichever philosophy that company has chosen. Now, here's a phrase you'll hear constantly once you start paying attention to financial news: bull market and bear market. A bull market describes an extended period where prices are generally climbing and confidence is high. A bear market describes an extended period where prices are generally falling and caution dominates. Think of them like seasons. Neither one lasts forever, and historically, the stock market has moved through both repeatedly, again and again, across every decade for which records exist. So, with all of that laid out, what's actually true and what's actually a myth for a complete beginner standing at the very start of this? The myth is that the stock market is some kind of get-rich-quick scheme, or that picking the right company at the right moment is a shortcut to guaranteed wealth. It isn't, and anyone promising you a formula that removes all risk is not being straight with you. The truth is closer to something far less exciting sounding, but far more historically reliable. Ownership in real, productive businesses, held over long periods of time, spread across many companies rather than concentrated in just one or two, has historically been one of the more effective ways ordinary people have grown their savings, precisely because it isn't a shortcut at all. That's the real lesson sitting underneath all the unfamiliar vocabulary you started this video confused about. A share, an exchange, a dividend, a bull market, none of these ideas are actually complicated once you strip away the jargon. They're just names for very human behaviors: ownership, buying and selling, sharing profits, swinging between optimism and fear, repeated by millions of people, all at once, every single day. So here's a question worth sitting with as you close this video. Now that you understand what you're actually looking at underneath all that unfamiliar language, does the stock market still feel like something confusing happening somewhere far away from you, or does it start to feel like something you finally have the vocabulary to actually explore for yourself? Let us know where you're starting from in the comments.